and welcome to this session of the live coaching classes organized by the Board of Studies of the Institute of Chartered Accountants of India. We had already started share capital and debentures, possibly one of the core topics in Companies Act, around which much of the benefits of the corporate form of organization revolves around share capital and equity. So we went through quite a lot of topics, basics, and we saw the two types of capital. We saw differential equity shares with differential rights, right? And we saw that. Now there was an interesting question in the query which I didn't answer last class. The question was very simple. Somebody was asking, I forget who, possibly Mr. Hitesh Jain, because I saw his good morning, and Ms. Maimon Rafiq Bhai. Others I didn't see good morning, but I assume, Prabhas is here. I assume Antanjali is here. I don't know. I'm assuming all this because it's not a physical class. So we shall presume that these students are here. And anyway, whoever asked this question, it's interesting for all of us. Question was, see, in this example, equity shares with differential rights are having one vote for two shares. So guys holding, so many of you are coming. Yes, Mantanjali is here, Mageshwaran, Parampreet Kaur, Swarup Singh. Okay, Swarup Singh is, whatever. Hey, again, I'm repeating it. Any technical issues, please do not put in the query pad waste, because I cannot control it. You go to the Institute Tech Support guys. If really there's a problem, they'll inform me, we'll do something about it. But otherwise, there's no big deal in putting it in the query pad. Rather use the query pad to ask questions. Coming back to the point, 2 lakh shares. So 2 shares will get 1 vote, which is half. So 2 lakhs will get 1 lakh votes. No problem. Somebody asked me a question and it was interesting. Can there be higher number of votes per share? Okay, I said I wouldn't answer it immediately, but now after considering the section and other things, I think there is absolutely no problem, because the real control is here. All they are saying is you do whatever you want, so long as the voting power of all shares with differential rights should not exceed 74% of total voting power. This is the condition, and this is the limitation also. You can do whatever you want. It's a contract. So, for example, suppose I am issuing equity shares with differential voting rights. Okay, in this example, instead of 2 lakhs here, imagine it's 1 lakh. Let's assume that this is 1 lakh. But here the terms are such that each share will get 2 votes. So 1 lakh shares, DVR shares, 1 lakh shares will get 2 votes. Right? Nothing else changes except the term. Dividend need not be sacrificed. There's no need that because I'm getting higher voting right, I should get a lower dividend. Not necessarily. Though that could also be part of the terms. It is contractual in the sense the company issuing the shares in the offer letter or prospectus decides what it's going to give as terms. And if the applicants or if the other party agrees, means he likes the terms, he will apply and then allotment with that contract. So now it's a contract. You decide what you're going to do. So here is the company which is issuing 1 lakh shares, but 1 vote carries 1 share carries 2 votes. So then do the math. What happens now? The number of votes here would be different. 1 lakh normal equity shares will get 1 lakh, 1 vote per share. But this 1 lakh DVR share will now get 2. So 2 lakhs. So the total would now become 3. The total voting power will be now 3. Out of which voting power of equity shares with DVR would be 2 lakhs. 2 lakhs by 3 lakhs gives me 66.66, which is still okay. So long as the voting power of all shares with differential rights do not exceed 74%. See, one more example. Suppose 2 lakh shares, equity shares, 1 share, 2 votes. 2 votes for 1 share. What happens? The number of votes, 2 lakhs will multiply into 4 lakh votes, whereas this will continue to be 1 lakh. Total voting power 4 plus 1, 5. Differential voting right shares will have 4 lakhs. 4. So 4 by 5, 80%. Now you can't do it because you will violate the condition of 74%. Right? It's a good question. I appreciate, I forget who it is. I'm not able to remember, but if I go to the query pad, I will. Whoever it is, thank you for the question. I hope the clarity is now available. But I was thinking, who will want to do it? But then you see anything can happen. For example, there could be a joint venture where there are two joint venture partners. They want to bring in equal amount of capital. Capital-wise, they want to be equal, but one party has an edge over the other, negotiation-wise. So they might say, look here, I will also bring in the same amount, but my one share will get 2 votes. Thereby, he will get a controlling interest. See, the same math, if I get 2 votes, 66.6, I'll get a controlling interest in the company. So that could be their understanding. So nobody can, see, the law doesn't prohibit you from having any number of understanding. Depends on the contractual situation. So maybe this guy has got some technology or this guy has got something. So he says, look here, I cannot bring more money. I'll bring the same amount that you are bringing in or even less. But my share will get more vote. I'll get controlling interest. If you agree, deal. Otherwise, no deal. Then it can happen. Okay. But this need not involve reduction in dividend. That is different. If you want to also, no need. But if you want to do that, okay, I'll give you a higher vote. See, but that's no charm. Whereas I was thinking when this could happen is in a real situation where some person has some, so for example, I have an attractive land and I want to bring it in, but I want to say, see, this is my land, I'm bringing it in. If you want me to bring the land as capital, convert it, then you will have to give me double vote. And if the other guy is so desperate, he might agree and they might form a company where this type of a relationship is there. See, friends, the Companies Act is an enabling law, framework law. It is not a prohibitory law like the Indian Penal Code. Though there are many penalty sections, the basic purpose of the Companies Act is to enable business. So in that spirit, you can do, so long as you are not doing anything violative. There is no violation, there is no prohibition for this in the Act, except this 74%, which you have to keep in mind. Okay. So we've already seen this. I think see, one more small thing. Some of you might have had a doubt. Hey, there you said existing shares cannot be converted into DVR shares. Here you are saying you can vary the shareholders' rights. Correct. What you cannot do is existing normal equity shares you cannot convert into DVR. But existing equity shareholders, you can vary their rights. But for this, there's a procedure. You have to get the consent of 3/4 of that class. And if some other class will be affected, that such other class also should be obtained. Right? And dissenting, see, the most important point here is if there are any people who don't agree, then those dissenting shareholders should be paid and they should be sent. Then only you can do it. Okay. This is a point. So the dissenting fellows can go to the tribunal and the variation can be cancelled. And so provided they are not less than 10% of the issued shares of a class. And they should not have consented. When the vote was taken, they should have dissented. Not what they should have. See, neutral is not against. I wanted to keep this also in mind. When we come to management and administration, man doesn't vote. He is not against, nor for. He's neutral. Don't count him at all is the point. Don't count him as against. If you want to be against, you have to be against. If you want to be for, you have to be for. If you say, I'm neither this, there, sitting on the wall, chalo. But that vote will not be counted for total votes itself. The votes which are cast only we will take. There only we have to count whether the number of votes exceeds for an ordinary resolution. Number of votes cast in favor, 3 times the number of votes cast against, if any. Okay. So I'm sorry, I'm drumming in this definition again and again because students, I don't know where you learned this, 2/3 majority, 3/4 majority and all that. Maybe people who taught you in college or who taught you in some other thing, they themselves didn't read the original section. I have a feeling. That is when the 3/4 majority, 2/3 majority and all. So from now on, I hope you may all call yourselves my students. If you are all going to be through me, you are the students of Professor K.S. Anantaraman. Never forget that. Because my guru is Professor K.S. Anantaraman, who is no more. 2014, he passed away. My guru. So, and his book on company law, I don't think it's still in print, but check it out. Lectures on Company Law by K.S. Anantharaman. Very popular book in those days. Point I'm making is, since you are, if you think of yourself as my students, then you are also the students of K.S. Anantharaman through me. And he used to be very tough on people who didn't know special resolution, because he will say, don't say this. Don't say 3/4 majority. Don't say 2/3 majority. No, nowhere is it 3/4, 2/3. Yeah, don't argue and say, sir, it could become. Once in a while, it could become. But when you come to management administration, I'll show you that that definition you have to clearly remember. The number of votes cast in favor for a special resolution, the number of votes cast in favor of the resolution shall be not less than 3 times the number of votes cast against, if any. Neutral votes not to be counted. Only members who are present and voting should be counted. In that, you have to see how it is working. Okay. We'll give you some examples also when I come there, but I thought this is something, the special resolution, you will come across its dirty term so many times. So better we get this behind us, is what I would humbly suggest. Moving on. We go on with our session where we left off in the last class. Okay, that was Himanshu Gupta. Yes, sir, thank you. I hope, Gupta ji, some clarity has come. If so, I would love that you should confirm that whether my explanation was useful to you or not. Because that's, see, it feels happy, because we are addressing the void. I don't know who is who. In fact, I didn't even know that Mukta is a girl, but Mukta Vyas. So, so I don't know, because I can't see her face. Now I know. So the point I'm trying to make here is, do give us some sort of a occasional confirmation. Anyway, now calls, okay, made on shares to be on uniform basis. When will you have the concept of calls? When will you have a concept of calls? Okay. Oh, thank you. When will you have the concept of calls? When there is partly paid share. When the amount of the nominal value of the share is not fully paid. In which case, there will be an amount unpaid. Now, that unpaid is also uncalled. When you are making a call, means when the board of directors are sending a letter to all the shareholders saying, hey, you have to pay me balance amount or one more installment of your face value, then such calls should be uniform. Means 10 rupees share, 7 rupees called up, no problem. Now the board of director wants to call up further amount. They cannot send 3 letters. One, some people don't bother, yeah. Some people pay 2 rupees. Another said, pay 3 rupees fully. No, it is not possible to give such differential treatment. If you are going to make a call, it has to be made on uniform basis on all the shares in that class. And there should be no differentiation of a given class of security holders, whatever it may be. See, you may say senior citizens, no need to pay the call money. No, everybody should be pay the call uniform. Okay, this is just a precautionary section. It is to prevent people from doing this. We come to calls in advance. I'm sure you are familiar with what that is. Calls in advance is a man is there. In our own example, 7 rupees called up and paid up, 3 rupees uncalled. Okay. Now what this gentleman does, when he sends the money, he sends amount for the 3 rupees also. He's holding 200 shares. As of now, 200 into 7, 1,400. But our man sends another 600 also. He sends 2,000 rupees. He says, keep the money. Whenever you are making the call, adjust it. Right? So, a company may, if so authorized by its articles, accept from any member the whole or part of the amount remaining unpaid on any shares held by him, even if no part of that amount has been called up. So that is called calls in advance. What is important to be noted, there should be an authorization in the articles. But a member cannot exercise voting rights in respect of that advance payment. Means all others are paid 7, he alone has paid 10. No, he cannot come and say, I will get full vote, whereas they will get only 70% vote. No, You pay, don't pay, that is your problem. Everybody gets equal. So, member cannot exercise voting rights in respect of the advance payment. Can the dividend be paid on the calls in advance? Yes, you can, provided it is authorized by the articles. Please note this very carefully. If so authorized by the articles. See, in the exam, sometimes when they ask a question, they might forget to mention authorized by the articles. They might forget to mention about. So they might go directly into calls in advance and ask you some question on that, some dividend or anything. Point I'm trying to make here is, if there is no information in the problem, okay, if it is multiple choice question, you are off, because no assumptions and all can be written there. You have to take a, if the problem is silent about articles, you assume that there is no provision in the articles, do not pay dividend on calls in advance. Do not pay. But if the problem clearly says there is a provision in the articles, then pro rata you can pay to on the calls in advance also. Got it? Chalo. Secondly, and calls in arrears. Now, calls in arrears and of course calls in advance also will be displayed in the balance sheet under the head share capital. Right? Under the head shareholders funds, first heading share capital, you will have your authorized capital, you will have your issued capital, you will have your subscribed, called up, paid up. Now the total paid up capital, you will reduce calls and arrears so that it will tally, so that the book entry will tally with the actual amount received. Right? So that is calls in arrears, which will be displayed as a reduction in the thing. It's a liability, no doubt, but it will be reduced in the paid up capital and it will be shown. To that extent, the paid up capital will be, it will be there, right? Okay. Because you would have debited, see, what entry you would have passed? Share first call account debtor to share capital. Am I correct? So the share first call account will be lying in the technically in the asset side under so possibly current assets classification, assuming, because you have to receive it within the next 12 months. I'm assuming. Okay. If so, you should show it on the asset side. Instead, what you are doing, you are reducing it from the share capital as calls in arrears. Friends, I'm possibly insulting your intelligence. You are all extremely intelligent students of the Institute of Chartered Accountants of India, not Institute of Company Secretary. So maybe I'm wasting your time, my time and your time teaching you accounting. I should not be doing it. Sorry. Premium. Issue of shares at a premium. Premium means an amount which is paid above the face value. So if the share has a nominal, see, nominal value, face value, all are same. If a share has a nominal value or face value of 10 rupees, but when you're issuing to the public or when you're offering it to somebody on offer basis, on private placement, whatever, you're saying, look here, 10 rupees is the face value, but today my company is worth much more, yeah. So you do a valuation and you arrive at the enterprise value or you arrive at the intrinsic valuation of that company. Okay, and then divided by the number of equity shares, you will get the face value of, you will get the value of an equity share. You can even say free, what shall I say, fair market value, FMV of a equity share. Now, once you decide on the FMV, out of that 10 rupees is the nominal value. The difference is premium. So, for example, let us say 240 rupees is you fix the valuation. Out of the 240, 10 rupees will be face value. The remaining 230 rupees is securities premium. So premium is the difference between the issue price and the face value. How is the issue price determined? By valuation, right? Which is where possibly LIC, not wrong timing. They got it right. And see, people who are only interested in making short-term money may feel let down by the fact that LIC is quoting lower. But if you are a long-term player like me, you shouldn't bother. Okay, hold it. So LIC is not going to run away tomorrow. Yeah, it's going to be there. So many things will happen tomorrow. See, don't judge by the next 5 days, 6 days, immediate. In the long run, I don't think there is any problem. Currently, it's quoting below the issue price. But the nominal value is 10 rupees, right? Got it? The share, I think it was issued at 944 rupees. So that makes it what? I assume that it's 10 rupees per share. I seriously don't know. I think it is 10 rupees per share, in which case you will get 935 as the premium. Whatever it is, when shares are issued at a premium, the amount of premium received should be transferred to an account called securities premium account. The securities premium account will be shown under the head reserves and surplus. The second item on the balance sheet, reserves and surplus. And it will be treated as if it is part of the paid up share capital. Means, again I'm telling, because you are saying it will be treated as if, so it will be shown under reserves and surplus, but for all intents and purposes, the securities premium account will be treated as paid up share capital, which means fundamentally you cannot use securities premium account for declaration of dividend. So if you want to declare dividend, securities premium account cannot be included, which means securities premium account technically is not part of the free reserves. See, the word free reserves you would have seen in the definition. For your benefit, I will sort of give you this concept. See, dividend, the word free reserve is linked to dividend. Free reserves are those reserves which are available for declaration of dividend. Please hold on to this thought. Free reserve means any reserve which is available for distribution as dividend. So, which would you, because in the exam you might be given so many problem type of questions where this could be one of the important issues. So how do I know which is not available, which is available? Simple. Is it available for distribution of dividend? When it will be available for distribution of dividend? When it is generated out of a revenue profit. From the P&L appropriation, I have transferred amount to general reserve. So basically my current profit, which I have earmarked and set aside as general reserve, it is available for distribution as dividend. You can call it any name, a dividend equalization reserve, whatever. If it is sources from the P&L, you can take it. Securities premium account, sorry, it is capital. It is a capital profit which you have got. It is nothing but that the valuation you're getting at the current company is getting it, right? Now, so the securities premium, so what I'm saying is it's not available for declaration of dividend, therefore not. But some cases they will include securities premium account. Buyback of shares, you will see, buyback can be made out of securities premium account also, right? Because it's part of the permanent paid up share capital. Anything that the paid up capital can be used for, you can use this. But you cannot declare dividend because, very important, later on when you come to dividend, I hope it will be stressed. One of the important caveats of the Companies Act is thou shalt not declare dividend out of capital. Thou shalt not, it's a commandment, I would say. Thou shalt not declare dividend out of capital. You cannot take 100 rupees from him and say, out of that 100, I'll pay you 10 rupees. Later on, when you come to discount, I will stress it again. Capital cannot be used for declaring dividend. You want to declare a dividend? Make money. Use that capital, generate revenue, and make a profit, and out of the profit, declare a dividend. This is the, so in case current year profit is not sufficient, go to your reserves and all that. But that reserve should be revenue generated. Later on, we'll be seeing capital redemption reserve. When we come to redemption of preference shares, etc., we will see CRR. Capital redemption reserve also cannot be used for dividend. Why? Because what is actually happening in, okay, when I come to redemption, I'll tell you, but CRR cannot be. When I come to redemption of preference shares, I'll tell you this, don't worry. Like that, your real doubt could be capital reserve. Sir, is capital reserve available for declaration of dividend? Capital reserve, I'll ask you what type of capital reserve it is. Suppose it is some kind of, for example, if you remember your accounting, very, very basic, your +2 accounting or whatever your foundation accounting, whatever you call it, CPT, KPT, whatever, you'll remember. See, when you forfeited shares, what happened? The amount which this Bakra had paid becomes forfeited share account. Okay, it's an income. It is a capital income, but received in cash. Then what happened? You reissued the share at a discount. Whatever discount you offered, or rather concession, I shouldn't use the word discount, concession you offered for this for the new guy, you reduced it from the forfeited share value. The difference, you took it to capital reserve. that, sorry, it cannot be used for declaring dividend. Why? Because it has come a capital profit, yeah? Clear capital profit, I cannot use it. It has to be there. You just keep it, that's all. But suppose you had a land and that land was sold, or a fixed asset was sold at a nice profit. So you generated that money has come to you in cash, has been realized in cash. So such capital profit, when it is transferred to capital reserve, there is a view that it can be used for declaring dividend, right? There's a view, because section doesn't say anything. It's a view that provided the profit is realized in cash. Money, cash means money, okay? So it should not be notional. For example, your so-called revaluation reserve, and I hate this revaluation reserve. As a pure accountant, as a puristic accountant, I should say, I tell you revaluation reserve is ultimate cosmetic, window dressing. But many times banks and promoters, they want us to, Mr. Srikanth, my asset value is so much. Well, the way you are accounting, it is not reflected. What the way I am accounting? The way the world is accounting, it is historical cost, Baba. I can't show assets at notional values in the balance sheet. For me, historical cost is a safe anchor. This is the amount you paid on those days. I have accounted it at that price because I got evidence for that. Now, if you say today it is worth X, another person will say it is worth Y. How can I decide which is right? So, accountants rightly and prudently for thousands of years, we accountants have decided not to violate historical cost, except in rare cases when we go for current market value, current price valuation, mark to market, volatile security, etc. I don't want to go there into that subject, but the point is, fixer, your land cannot be shown at current value. But if you still want to do that, what will I do? Okay, bring it. What entry I will pass? Fixer assets account data to revaluation reserve. I create a reserve. What reserve is it? Is it real money? No. It's a notional. This fellow is telling some valuer, I don't know what he is telling. Okay, Jalo, I'll take it. I'll take the valuation report, keep the man's name and phone number to give to CBA in case they want, and I will pass the entry. For me, that is all, because that valuer then is in trouble. Because tomorrow, if that's a problem, Allah, I depended on the valuation, yeah, and that valuer is a registered valuer, so please go and catch him. I'll keep his mobile number and address and membership number to his institute and also to the RVO. Go and please catch him. So what I'm trying to say is a notional. That amount cannot be used for declaring dividend. 100% it's not possible revaluation. You cannot allot shares also out of that, sir. Bonus shares cannot be issued out of revaluation reserve. We'll see that. Okay. When I come there. You might ask me, why are you wasting my time giving me such an elaborate discussion on free reserve? Because this topic that word free reserve will keep coming again and again to a student of company law. So therefore, be very, very careful. Okay, so company may only pay dividend in proportion to pay. Yes. When you come to dividend, you will learn this. Actually, I'm jumping the gun, but dividend will be declared on the face value, not on the market price. Whatever price you bought it, that is your cost. Okay. But as far as the company is concerned, dividend will be calculated as a percentage on or even a proportion of face value. Okay. What if a company's articles doesn't authorize calls in advance? Amend your articles. That is all. If it is not authorized, you cannot give dividend on calls in advance. If you still want to do it, pass a special resolution. We saw that now already in the incorporation topic I taught you. You want to alter your articles, please pass a special resolution, file your MGT 14, enjoy, give some business to a company secretary. That's all. What else? Okay. Good question, Pooja, but I think it's very obvious answer. No? What do you say? So in case you can always amend your articles, no. But believe me, the standard table F has the provision. Okay, table F has the provision for this, no problem. If you're not using table F, which is always good, use the standard, then you should make a provision in the articles. See, now that you know about it, as a future member of our institute, remember, in the articles, you see that it is there. Exactly, Hitesh, you are right. CRR is used for blocking a profit. I don't want to go there now because when I come to redemption of preference share, I will tell you. My problem here is all of you people are so knowledgeable in company law. I don't know why at all I'm teaching you. In fact, I am like Mullah Nasruddin. See, Mullah went to the mosque and he asked everybody, do you know what I'm going to talk about? They said, we don't know. Mullah said, hey, you guys don't know anything, and he went away. So next Friday, they called him. Man goes there. Do you know what I'm going to talk about? People said, hey, we know. And he said, you guys know everything, man. Why should I tell you? Which is my position, I think. Then I went off. He went off. Then third week, the man comes and he says, do you know what I'm going to talk about? Third week also, the people don't know what to know. So some of them say, I don't know. Some of them say, hey, we know. Then Mullah says, those who know, tell those who don't know. Okay. Sometimes in my physical classes, especially for adult learners, not for students like you, for adult learners of, in corporate training, I don't teach them anything. They teach themselves. Because experiential sharing. So I say, come on, what am I? You got a GM sitting there, DGM sitting there. All of you are big shots here. Come on. I will only provoke the thought. You talk and facilitate. I will not teach. But this is not like that. This is for students. I have to teach you to the extent that whatever little bit you don't know, I will try to fill the gap. Okay. Securities premium account. This is very, very important. I'm sure you know it because this topic will overlap with accounting. You will find many of the topics we are studying today, you will also study in accounting. The professor who comes for accounting would also reinforce it. So it's quite possible that you already studied all this from a different perspective. So, yeah. See that GSRE, actually, I think government something is there, something. I'll check up and tell you. But all these notifications have that GSRE. Abhi to mujhe nahi malum. I will tell you. Okay, I will tell you. I mean, I will just verify and I'll get back to you. But it's there in all. Nice. That means that you have gone through some notification. Good. You have seen the GSRE. Okay. Good show. I forget the expansion anyway. But maybe some by the time I finish, don't worry. Somebody will go to Google, tell you. So those who know will tell those who don't know, including me. Okay, don't worry. See, knowledge is a public property. Nobody has a monopoly on knowledge. And nobody can always have a monopoly on knowledge. As we keep talking, knowledge will shift. I'll come to Prabhas. I'll take up a question at the end of the class, which remained unanswered. I forget what it is. Maybe because you answered, the question was a little confusing. So I might have said reword. Whatever, it's okay. I'll check it out, but not now. Don't let us not disturb the flow of this topic, which has to be completed. Do not, at this stage, do not ask any questions outside of this topic. End of the session, nearing the end, around 9 o'clock, you put it. I will check it. Yeah, Pooja, please go ahead and put. I have absolutely no problem. Please share. Please. Okay, please. Okay, I'm not against them. I'm saying some of you may definitely be feeling it, but I have to cover it for the benefit of students who may never have studied it. There are people like that. There are people who walk into our institute from remote parts of the country, villages, rural districts are there, where they studied in local colleges, where they don't know anything, and they want to become CA. For their sake, you have to go slowly, and we have to inform them about very, very important areas which are very obvious to some of you, may not be for everybody. One of which is the securities premium. See, securities premium account may be applied by the company only for 5 things. First, towards the issue of unissued shares of the company to the members of the company as fully paid bonus shares. This is a very elaborate way of saying issuing bonus shares. So, security premium account can be used for issuing bonus shares. Means the shareholder pays nothing, but the shares are credited to his account. It's called bonus issue. Securities premium account can be used for that. Of course, your free reserves also can be used for paying bonus shares. Suppose you got general reserves, you can use it. Securities premium account can also be used. Also, in writing off the preliminary expenses of the company. Preliminary expenses, when the company was incorporated, the promoters would have spent money, right, for incorporating the company. That is called preliminary. That is a capital expense. It can be written off, but over a period of time, but not in one shot. It's not a revenue. You can write it off over a period of time, say 5 years, 10 years. But in case you want to do it in one shot, you can do that against security premium. In the balance sheet, preliminary expenses will be shown as a reduction under reserves and surplus. Because earlier they had in the old balance sheet format, Schedule 6 as we used to call it, they had a column, they had a item, they had a heading called miscellaneous expenditure and losses. There's a heading in the asset side, there should be a loss. That is, those items which are yet to be fully written off, they are debit balances, right? And I'm not taking it to the P&L account as an expense. So where will I show the debit balance? It's not an asset there. So I used to show it under this fictitious asset head. But now in the new law, they have international globalized our law. There is no such items cannot be there in the balance sheet. Straight away, you take it to the reserves and surplus and reduce it from the reserves. Right? It will come as a negative item there. Now, if you want to adjust it fully, throw it out of the books, you can use a securities premium. In writing off the expenses off or the commission paid or discount allowed on any issue of shares or debentures. So we already saw an underwriting commission, brokers commission, all that. And in case you are allowing any discount on issue of shares or debentures, in a short while, I'm going to tell you, you cannot issue shares at a discount. So don't immediately jump on my throat and ask, sir, you said no discount. How you at that time you said discount? We are not only talking about shares here, we are also talking about debentures, etc. Shares cannot be, we'll come to that point, I'll tell you, issued at a discount. And that too, there are two notable exceptions where you can issue it at a discount. Okay. So if you are incurring any discount, it's a capital loss, right? You have to either write it off over a period of time, or if you have a security premium account, square it up. In providing for the premium payable on the redemption of any redeemable preference shares or of any debentures of the company. Okay, so what you have is, when you are issuing preference shares or debentures for that matter, you can say, I'm issuing now at 10 rupees, 100 rupees, but 5 years later when I'm redeeming, I will give you 125 rupees. That is called redemption at a premium. You can redeem at a discount also, nothing wrong. Okay, or you can issue at a discount, but issuing preference shares at a discount, not possible. At par, but you can redeem it at a premium. Means 5 years later, I will be incurring. Okay, so I'm sure you know. All this is, see, that is the problem. This is overlapping with accountancy. So I'm sorry, if I'm wasting your time, I'm very, very sorry, but I'll go through fast. Similarly, so that premium on redemption is a cost. It's a capital item. You'll keep it as a negative in the reserves and surplus. That can be pushed out of the balance sheet by adjusting it against security premium, right? Finally, and very importantly, fifth item, security premium can be used for buyback. Maybe in the next class, I will talk about buyback of securities. At that time, if security premium account can be used for buyback, right? Now, unlisted companies, private companies, and listed companies subject to SEBI, listed companies subject to SEBI regulations may apply security premium account. See, in addition to these 5, the rule 3 gives you 3 more items. 1, in paying up unissued equity shares as bonus shares, in writing of the expense or commission paid for the purchase of its own shares or other, under 68. Buyback is different. Purchase of its own shares or other securities is also there, right? You can use it for one of these items. In addition, this is in addition to, but I seriously don't see what is paying up unissued equity shares to be issued to the members as fully paid bonus shares. I don't know. See, the problem here is these guys have created so much tangle. One side they have section, another side they have rule. Central government goes around and does anything it wants by amending the rules. So many overlaps. You will find many things which are mentioned in the section are again mentioned in the rules. Oh, unnecessarily. It is there in the section. Again, you say, so and so form should be. What is your job? You tell me what is the form number in the rules. Okay. But there in the section, he already told within 30 days. Again, here they will give 30 days. Now, bigger question, which some of you might want to ask. Sir, if there is something provided in the rules and something provided in the act, which will be superior? See, the rules are telling 30 days. The act is telling 60 days. So, is it 60 days or 30 days? I'm sure the answer is obvious. Okay, so the answer is, yeah, you can tell me. There is a conflict between the act and the rules, which will prevail? The act or the rules? I will not answer. You can tell me what you think is the answer. Sure, you will get it right. Section 53 prohibits issue of shares at a discount. It prohibits issue of shares at a discount. Okay. Straight away. The reason again is, thou shalt not declare dividend out of capital. See, he is giving me 100 rupees. That is a face value, or 10 rupees face value. Straight away, I'm telling you, give me only 8 rupees, keep 2 rupees. No need to give. That means I'm giving a dividend out of capital. Yeah. Even before I got the money, I've given him. Now, when I'm repaying that amount at the end of the winding up, the company will have to give back 10 rupees, not 8 rupees. Though this guy only paid 8 rupees. So, in a way, he is getting his dividend up front. Not possible. So, issue of shares at a discount prohibited. Okay, so the discount is the reverse of premium. 10 rupees share issued at 8 rupees. Issue of shares at discount may affect creditors, because at the time of liquidation, the holders of shares issued at discount price will receive an amount more than they have paid. Got it? So he paid only 8 rupees. At the time of winding up, he'll get 10. And it will affect creditors. Am I correct? So the general rule is that company shall not issue shares at a discount. Any share issued by a company at a discount price shall be void. The issue is void. Means the fellow cannot claim any right as a shareholder. Void means nullity in law. Okay, so no need. It won't have any legal effect. Mainly, see, suppose you have issued shares at a discount, 100 fellows have applied and they have got these shares. Those 100 fellows cannot, their money is there. It's a liability to repay, but it is not shares. They cannot claim the rights of a member. The money will be there, maybe you can refund. That's why they say, when you have issued shares at a discount, we are saying it is void. No, the money is with me now. So what will happen? So they say, in addition to the penalty, the company shall also be liable to refund all monies received with interest at the rate of 12% per annum from the date of issue to the persons to whom such shares have been issued. So if you are going to issue at discount, it is void. Some bakras have paid you the money. That money you have to refund with the 12% interest from the date of receipt you have to give. From the date of issue, you have to give. Right? Now, one exception is given in 53. One exception, when you can issue shares at a discount. All the 3 items are same, absolutely correct. I don't know. It's not restriction. It is addition only. They are claiming it is addition. Because where is the restriction here? They are only giving the same thing. Restriction means it should further control. So there is no restriction. It is addition. As usual, half asleep, these fellows are creating rules. Welcome to the world of the Ministry of Corporate Affairs. Anything. Donkey will get up in the morning, decide to amend the rules. Without even bothering to read the section, he will amend the rules. Whatever is there in the section, he will again put in the rules. I don't know why they are doing all this. Okay, not me, maybe God. But nobody else can understand the peculiar workings of the ministry, the minds of the bigwigs at Babus at ministry. Beautiful. Yes, bonus. We'll come to bonus issue. I'll tell you at that time. Physical certificate is issued. Then, if a person have 1,000 shares, will you have 1,000 certificate? Very practical question by Ms. Rekha. No. What will happen when you issue share certificates? What we will do, in one share certificate, we'll have 100 shares. That's your choice. Even 1,000 shares in one certificate possible. In those days, when companies were listed and physical certificates were used, when companies were listed companies traded share, physical certificates were there. Now, at that time, per certificate 10 shares. That was called the standard lot. Per certificate 10 shares. But if you wanted more, you can do on all that. So they'll bunch up, say 100 shares in one certificate, 1,000. It depends. There is no rule there. Okay, so to answer your physical questions, Himanshu Gupta says rules. Swarup Singh says act. Thank you, Pujaji, for that reinforcement. Act will prevail. Act. See, there seem to be mixed. Act versus rule, rule prevails. Act is superior. Rules can be made, but it should be approved by Parliament. Then this is what, see, very, very fundamental question. Okay, I will tell you. Who is the most powerful body? Please understand one thing. Source of Act, Parliament. Act is passed in Parliament, amended in Parliament only. Rules are, see, that Act of Parliament will have a section which empowers the central government or the appropriate ministry to make rules. Now, the appropriate ministry with the delegated legislation, the rule-making power of the central government or the state government is called delegated legislation. So the Parliament says, look here, this is what, how you decide. We are saying this should be done, this should be done, this should be done. This is the law. How the actual, detailing of when to come, how many days and all that, you decide. You keep changing it also. So the central government is empowered, the appropriate ministry. In the case of Companies Act, it is Ministry of Corporate Affairs. There could be other ministries also, Ministry of Finance. So whichever ministry will be empowered to enact rules. So the central government, which is the executive functionary, is promulgating or creating the rules. Now, simple question to break the tie. Who is more powerful? The Parliament or the central government? There should be no doubt in your mind as citizens of a democratic country. The central government employees are appointed by the President of India, but the MPs and MLAs are elected by us. The Parliament is the superior body, legislative body. So the act which is coming from the Parliament will be always superior to the rules which are made by the central government, which is an employee of the government, right? Which is an instrumentality of the state. So rules cannot be more than give superior to act. Act is always, if there is a conflict between the section and the rule. And rules are not approved in Parliament. Rules are rules. Central government notify. That's why morning man gets up, he can notify a rule. Yeah. Simply they'll keep, for a long time we are feeling bored. Let us have a rule. Like that they will amend the rule. No reason, rhyme or reason they do. They can do it because they are empowered. They can do it. Of course, being an instrumentality of the state, they are supposed to justify why this is beneficial to the country or why this is beneficial to the economy. That the reason for that should be stated. That's all. And documented. Once they do that, the rule can be amended. So I hope you are able to understand this concept. Okay. So some lot of questions are there. So I hope you now clearly understood why Act is superior. Right. Shares may be issued at a discount to creditors when its debt is converted into shares in pursuance of any statutory resolution plan or debt restructuring scheme in accordance with any guidelines or directions or regulations specified by the Reserve Bank of India. Now, somebody is asking, they saw the slide, they are asking, what is debt restructuring scheme? I'll have to tell you, simple, Nirav Modi and all those people who borrow money from the banks, especially public sector bank, don't repay. The company is in deep shit, financially troubled. So now what happens? The company is having so many employees, the company is having so much thing, so public interest. So the Reserve Bank of India will see all the banks will be having such NPA clients, right? So they will come out with a scheme. They will say, look here, he owes you so much money, interest, etc. You waive the interest. That will be empowered by the Reserve Bank of India to all the banks. They will say you waive, W-A-I-V-E, waive. Okay, maaf karo. You remove, he need not pay interest, or maybe you don't put compound interest. Some concession will be given. Also, they might even adjust some amount of principal also. Any nonsense they will do. And they will also say, look here, poor fellow. He is my favorite child. He has borrowed from you, man. That's all he did. Why are you getting so angry? So what you do? You give him time. No, sir, no. Your bank can go to dogs, yeah. This man is my friend. Don't trouble him. Here is the scheme. So the Reserve Bank of India will formulate a scheme and it will be officially announced to the world that this is the debt restructuring scheme. Means it will become now possible for any bank, public sector bank or even private, so long as it's coming under the Reserve Bank of India, to restructure the debt. Restructuring means already he owes me 200 crores. He can't pay. With interest, another 25 crores. 25 crore maaf. Take it. No need to pay. The 200 crore, what I will do, I will convert it into equity. Say, what I will tell him, if you're capable of paying, kindly pay me 25 crores. Kindly help me, 25 crores. He'll, okay, take it. Remaining 175 crore, shall we convert it into equity and be, the restructuring scheme will mention. In case the bank wants, they can insist that the debt will be converted into equity. That's just a book entry. Yeah? The 150 crore was sitting in the debt, non-current liability now. So simply you will debit that, credit, instead of, it's already liability, debit, credit, share capital. Now when you're doing that, the bank also is affected. No. Why? Because already he has waived his interest. Okay. That money is lost. So how to compensate for him? So the government saying, chalo, in this case, if you want, you give him a concession. What do you do? When you are crediting the shares, okay, 175 worth the share, you don't divide by 10 face value. You divide by 8 face value. Thereby what will happen? He will get more shares. So some kind of a, shall we say, concession for this. Because they have the creditor, in this case I'm using the word creditor is used, but I'm giving example of a bank because more often than not, it is banks who use this method called debt restructuring scheme. Okay. And so see, after all, the creditors are entitled to interest. In case they are foregoing it as part of the scheme and accepting shares, then the discount will compensate them for the interest which they are foregoing. So later on, when the shares are, see, this could even be preference shares redeemable after say 5 years. It's part of restructuring, financial restructuring. When a company is having financial difficulty, we help them. Nursing, it's also called nursing. Okay, financial nursing, where you help them to come up. Okay, of course, my views are very strict on this. As a free market capitalist, according to me, public money cannot be squandered like this on useless businessmen who have, they don't know, second generation businessman. He doesn't know how to run a business. His father did a fantastic business. The fellow takes over, makes a mess of it, and you go and help him. Don't do that. See, let the survival of the fittest, let him die, let that company die, let better people come into the business, run the business better. This is the Adam Smith logic, okay? The F.W. Taylor logic, the ultimate free market capitalism. That doesn't work. Yeah. No. Please help us. Do some nursing, do some restructuring. Chalo. So that is a way, we have run this country from independence onwards. So that continues till, in which case you will have debt restructuring scheme and all that. Okay. So this is the same statutory resolution plan is instead of RBI, an act itself will be passed. The parliament will sit and pass an act, especially for certain kind of creditors in, they say, please, government, public sector, financial institutions, they may pass a law. So statutory means a law. Law is passed in parliament. Debt restructuring scheme will be Reserve Bank of India, which is again delegated. The Reserve Bank of India is part of the Ministry of Finance. Again, an instrumentality of the state. So they will be giving guidelines. They may be giving some rules and all that. Okay. So this is what this is one exemption for issue of shares at a discount. The other exemption we will see sweaty equity shares. When I come there, I will tell you. Only 2 cases you can issue shares at a discount. Otherwise, no issue of shares at a discount. In case you don't comply with the rule with this and issue shares at a discount, that will be void. Also, the company and every officer shall pay a penalty of an amount equal to the amount raised, or rupees 5 lakhs, whichever is less. So 5 lakhs or amount raised or 5 lakhs, whichever is less, and the amount which was collected should be refunded with 12% interest per annum. Right? Okay, good. Any questions left? We already, what is debt restructuring? Rule will override because it is the recent amendment to law. No. Nice. It's all nice way of putting it, but I hope by now you are clear, no, principle wise. See, you know what I would love? Suppose some of you are now clear about what is section of the law and what is the rule and why the act of parliament is superior to the rule. If you've now understood it, just confirm. I have understood or whatever. It gives me some feeling, chalo, we communicated. Some of you are very innovative in the way you are giving the rule. Why the rules? Again, Ramakrishnan says rules can be made, but it should be approved by parliament. No need, sir. Because the parliament at the time of passing the act will put a section saying central government at its discretion can formulate rules from time to time. But rule cannot override the parliament law, right? This is the point. Pooja, you are arguing. I appreciate your argument, but please note, in the section, what did they say? There they gave the opening for this. The section did not say 50 and the rule is not 200. What does the section say? 50 or such amount, such number as may be prescribed. Once you see that as may be prescribed, that's all. The central government can do create any number of rules. You got it? So there is no conflict there. It is not a conflict. The section clearly says, in the act we are putting 50, but it can be such number as may be prescribed. You can put there. So 200. Okay. So using that power only they have done it there. Got it? That is the example of a rule making power, where the act very clearly says as may be prescribed. So it's a good question, but I hope you will understand it. Absolutely correct. So there's no conflict between the two. Okay. Because it's part of the rule making process. In the act, wherever you say as may be prescribed, that means Parliament has said, look here, we have given this view, this is what it is. But within that framework, you as a central government pass rules or prescribe. That is when they will create rules or amend the rules, and that will be notified and all that. A rule or an act of Parliament will come into effect on the date when it is notified. So the circular which publishes the rule or the amendment will also clearly mention when it will come into effect. For example, many amendments have been passed in Parliament or rules have been made by central government which have not been notified or announced. They will publish it in the Gazette also, but they will not notify. Later on, they will have one more notification circular where say that rule is now notified. So the date on which it comes into force is very, very important. For that, there is something called the Official Gazette, which is published by the central government and the state government. It's a public document. Every citizen of the country is entitled to see the Official Gazette, though it will be boring. Don't even go there. Lawyers subscribe and they keep it, the Official Gazette. So in that Gazette, they will publish it. Whenever the act is amended, the amended law will be published in the Gazette. Then the notification of that amendment will come separately sometimes. Sometimes in the same notification where they publish the act amendment or whatever, they'll say with immediate effect. That means immediately it will come. But if it is to be notified later, they will notify it separately. Okay, like that. Recently, the 2020 amendments were there. That they never notified it. Then 6 months later, they notified them. Separate circular notifying, wherein only said the following section shall be with effect from 21st of February 21. Like that. They got it. It came into effect from that day. Okay. So I know it sounds a little complicated, but that's how government runs. Okay. That's how government runs. Right. Now, as I told you, we'll have to talk about sweat equity shares. Section 54. As the name implies, the word sweat. So when you will have sweat, when you're working. So employees, they are giving their sweat. Sometimes the blood also. In fact, some of my employees, I will tell them, I don't want your life. I only want your time. Do a good job. You come in the morning at 9:30, 10 o'clock. Be there till 5:30, maximum 6 o'clock. 5:30 also you leave. Within that time, you perform here. Sir, I will sit late and work till 9 o'clock, 10 o'clock in the night. I say, I never asked you to do that. I don't want your life. I only want your time. I'm paying for it. So please work. During that paid time you work, yeah, you don't have to sit late at all. Plan your work. This is what I teach my employees. I tell them, plan your work. Especially the girls, I tell them, don't stay late. Go home early. Finish your work and go. Plan your work and do it. This is my philosophy. This is somebody sitting late. But then some people sit late and I've rarely sat late because I'll finish my job. See, I plan my work. See, what is the ultimate goal? I'll achieve that. Like that. Anyway, this is again a personal view of this donkey, not necessarily the correct view. Maybe you feel that, sir, I am so sincere, sir. I will every day I will work till 8:30 p.m. for my boss, sir. If my employee does that stunt, I will tell him, boss, why are you sitting till 8:30? That means you're inefficient. Like they will get. That's why many of my people won't stay late. But target You finish what is your job? Did you send that statement? Did you finish this dry balance sheet P&L? Have you completed that? Finish now. Leave. Hello. Why are you sitting here? No need. This is my view. Both as an employee of Pricewaterhouse as well as a boss from 1991 onwards, I've been a boss. Rather, I've been an employer, never an employee. This is my view. But definitely employees are spending their blood, sweat and tears to work and make this company great. Therefore, we might want to give them some shares, as a sort of a thing, offer the shares at a lower price. That is why they say sweat equity shares means equity shares which are issued by a company to its directors or employees. Of course, there could be a guy who is both director and employee. More about it when you come to final. But whole-time directors are also, sometimes could be employees also. But directors as a class are also included here, employees. Now, these shares, which are called sweat equity shares, may be issued at a discount. Another exception. I'll give you two examples, you'll easily understand it. And again, please understand one thing. The share may be quoted in the market, listed share may be trading in the market at 750 rupees. Now, you might give this to your employees on sweat equity basis at 650. That is not discount. Because what is discount? Anything where you reduce it from the face value of the share. So 10 rupees share, if you are giving it at 8 rupees, that is discount. But market price is 750. You are making them an offer at 650. That's a concession you are giving. Boss, you've been my employee. Come on. Market is 750. To you, I'll give you at 550. Take it. Of course, the income tax department will come. The difference is perquisite. It will be taxed straight away in the hands of the employee when the shares are allotted at the, as a perquisite. Because, see, the difference is sort of benefit given by the employer, no? So, employee, it's a kind of employee compensation and it will come under the perquisite. Anyway, see, do you notice one more thing? All these subjects are intermingled and interconnected subjects. Forget your university experience where one professor taught one subject, that's all. Other subject don't interfere like that. Once you want to do a professional course and become a member, you should be able and willing to combine subjects and give solutions. Because, see, yesterday one client called me, we had a conversation for 45 minutes. He was asking GST, he was asking income tax, he was asking accounting, banking, everything. You have to give him answers. And clients don't want to answer day after tomorrow. At least you people are a little patient. You will wait for next class. Client wants aaj to abhi. Okay, like that. Because he's a businessman, he wants to earn money. I'm a supporting professional. I have to give him the answers. Solutions, not even answers. See, answer you can say you cannot do it is an answer. How to do it is the solution. For that you have to really think. Maximum all I can say is, sir, give me half an hour time. I will get back to you. And half an hour later, I should be there with the answer. Which means the real talent, once you become a chartered accountant, is not how much knowledge you have accumulated and kept in your brain and vomiting. No, it is how smart you are at picking up the knowledge quickly, putting it together and giving a solution to your client or to your boss if you're working in a large corporate. Okay, again, my humble view. So don't look at book learning. Don't look at mugging up. No, remember it naturally. Remember the subject naturally. Don't force yourself. Come on, if you keep reading it 3 to 4 times and think about it, it will stick to your mind. It is only when without understanding you blindly mug up or go to some coaching class, sit and vacantly look at the professor when he's talking, nothing goes into it. But once you get involved in the subject, like all of you guys are doing, so many of you are so involved, aware of the subject, the professor will fill the gap, he will give additional knowledge, correct your thoughts. That's it. That is how you should use classes. Anyway, having said that, employees can be given at a discount. Discount is on face value. You can issue on a face value discount also. Also, sweat equity shares may be allotted for consideration other than cash. Okay, I'll give a simple example you will easily understand. Mr. A is a direct. Mr. A is a, shall we say, leading doctorate in pharma. Possibly he was a research scholar and a research professor in a leading US university in US, right? He wants to come back to India, Mera Bharat Mahan, foolish decision, but he comes back and then he decides to, he's got some patents, which is in his own name. So he says, I want to invest in a company. I want a thing. So he goes to an existing pharma company and they are also happy to receive him because he's an internationally renowned professor and he's got patents in his own name. So then the director, so they have a conversation. Ideally, what that professor should do, he should take royalty for his patent. So you should say, look here, I will give you the know-how, but you have to give me royalty based on production. But the negotiation, this fellow is a smart man. He says, look here, pay me royalty. Plus, I want a stake in your company. For which, I will say 15 years later, the patent will be yours, or any additional discovery based on the basic patent will be company car. The original patent is mine. I'll get royalty till I die. Then my estate will get, my legal heirs will get. But based on my finding, if your research laboratory creates some more, that I won't claim. For that, you give me some 20% stake in your business and make me a director also. So, chalo, we make him a director and we allot him sweat equity shares. But what is he paying? He's not giving money. Instead, he is entering into a contract with us, giving us permission. Or he made another example. A might be having a huge land. So he becomes a director of a company, and instead of bringing in money, he brings in land. So you value the land at the fair market value, and to the extent of the valuation, you can give him certain equity shares because he's a director. Similarly, employees, when as part of the employment, they may make some improvements in the process. They may provide know-how, or they may make available rights in the nature of intellectual property rights. I gave that example of the pharma guy. That's a clear-cut registered patent. It is IPR for which he is entitled to royalty. And he is also saying, I will not, any future development out of this, I won't claim. And I want a stake in your business. Right? So take it. This is how negotiations should happen, right? Or value addition. Okay. So this is an employee. Whatever he does in the laboratory belongs to us. We don't have to pay him anything. It's not as if he did the research in a university and registered a patent. This is a clear cut. It's my laboratory. Yeah? You used it, you did it. So it's mine. But still, he is creating a value addition. So to motivate him, we can say, oh, your value addition is valuable. We will give you shares. So that is called sweat equity shares. Can be issued at a discount, can be issued for consideration other than cash. What is value addition? The actual or anticipated economic benefits derived or to be derived by the company from an expert or a professional for providing know-how or making available rights in the nature of IPR, intellectual property rights, by such person. Okay. Consideration for value addition not to be paid or included in the normal remuneration payable under the contract of employment. So it's an addition to his contract of employment. That is why all these additions, see, suppose he is getting it at a discount, he's getting it at a price below the listed price, market price of the share, the difference will be perquisite. It's an employee compensation, but addition to his salary, right? So a lot of such examples. In fact, one leading tire manufacturing company, one of their employees, he discovered a cost saving thing. He discovered that about 0.20 mm or 0.25 mm, if you reduce the nylon tire cord coating on the tire, still nothing happens. The tire will be as good as what it was. You don't believe, just removing the 0.25 mm of outer nylon tire cord coating, which is very costly, especially for the higher end tires, the company was saving huge amount of money every month they were doing it, because every tire you'll get a saving into number of tires. You calculate. So they said, okay, a portion of it we will give you as a share, equity share. Idea is to give incentive to the employee to create some value addition or process improvement. And directors to induce them to bring IPR and allot. Right. The only thing seems to be sweat equity is discount. Legally, you can give it at a discount on face value. Employee again can be a permanent employee, whether in India or outside India, mainly for software companies. A director of the company, whether whole-time director or not. See, because whole-time directors will also sometimes be employees. Part-time director may never be an employee, but even that director you can allot. An employee or a director as defined above of a subsidiary. Even the employee as defined above of a subsidiary or a holding company. Subsidiary may be in India or outside India. Holding company should be only in India. Okay. So to those employees also or directors also, you can allot sweat equity shares. So the procedure is the shares should be of a class already issued. Right? The authorization should be given by special resolution. Listed companies should also comply with SEBI regulations. What we are now seeing is Rule 8. In addition to Rule 8, SEBI regulations also, listed company SEBI regulation. There is a separate sweat equity regulation. Other companies, Rule 8. Sweat equity shares to rank pari passu with equity shares. Means, pari passu means in proportion. Actually, pari passu, it's again a Latin term, which means in equal step. So, whatever rights are available to the existing equity shareholder will be available to sweat equity also. Got it? So, at the time of winding up, both will be paid. It's not as if sweat equity share will be paid later. All of them will be, except that if the sweat equity shares are issued at a discount on face value, he may not get the. See, at the time of winding up, what happens? He will also get 100 rupees. I paid 10 rupees, I'll also get 10 rupees. He paid 8 rupees, he'll also get 10 rupees. That's what it means when you say sweat equity shares to rank pari passu with the other equity shares. Got it? Let's see if any questions are there. I'm sure there are. Thank you for that, Mr. Mageswaran. Anyway, my employees are happy. I'll assure you that. Okay, because that they are also proud of their achievements. When they do something, we celebrate. They are so happy. So it's a philosophy on which I work. I've been practicing for 30 years now. Come 22 July, I'll be completing 30 years of my practice, because the minute I qualified in 87, I got myself a COP. Then, of course, I worked in Pricewaterhouse. Then I started on my own. So I don't know, 22, 87, how many years? It's 35. Yeah. So whatever it is. So the point I'm making is 30 years I've never had any problem. This is the philosophy in which I built my firm and grew it. Okay, from a small 10-file practice to today 700-file practice. That is how it grew. Not by hitting my employees or insulting them or making them feel bad. Like that. So, yeah. Okay. Sorry for that. No needed, useless. Sorry. Coming back to the point. Equity shares are given other than salary. Yes. It is an addition. Dusra. Or in addition. Director has to pay on sweat equity shares, application money. Full money also sometimes. That depends on how you are issuing it. Yeah. Application money. Yeah. Money will be there. So, nowadays, but for Reliance, recent Reliance issue of partly paid shares, there has been no case of part payment and all. Straight away pay the full amount. Okay. So, but if there is the terms, then he will pay application money now. Balance when the amount is called up and things like that. Okay. Yeah, application money. May and shall additional equity shares, mandatory issue, private placement. Your question is very telegraph language. May and shall additional equity shares, mandatory issue, private placement. Pause. Seriously, I am unable to decipher your question. Would you like to put it in grammatically continuous, complete sentence so that I will be able to answer you, Mr. Rupesh? Sorry, because I'm not able to understand your question. If I can, I will answer. I can't. Maybe you are making some very important question, but I'm unable to understand it. May and shall, additional equity shares, mandatory issue, private placement. See, these are all loose words. There seems to be no preposition, verb, nothing connecting it. Okay, a lot of nouns are put together. I'm not able to understand. What are you trying to say? Kindly explain. What is the difference between ESOP and... I was waiting for this question. Muktaji, I was waiting. Not now. When I come to rights issue, I'll explain. Alag. But now if I start explaining, I'll waste your time. The time is there when I come to rights issue, there you will find the word ESOP is used. At that time, I will tell you what is ESOP. One difference I'll tell you. Sweaty equity shares will be issued, can be issued to specific employees and specific directors. Okay. You can discriminate. You can give to one employee, you need not give to other. You can give to a director, you need not give to employee. But ESOP should be uniformly offered to a class of employees. You cannot distinguish, you cannot discriminate. So the minute you say we are giving you an employee stock ownership plan or ESOP, you should create clear-cut classes of employees. People who have completed 5 years, 7 years, 10 years. Then based on his completed period, everybody who has completed 5 years will get 100. Everybody, that's your terms. How you do it is yours. But once you decide that, then you cannot say M will get, N won't get. Both, if they have worked for 5 years, they'll get. Whereas here you can be choosy in sweat equity. Whereas there you cannot. Once the scheme is published, any employee who is entitled to take the option and buy. Okay. So once it is there, I will explain more when you come to ESOPs. One more thing, ESOPs not available to director, whereas sweat equity shares available to director. Third difference, ESOP cannot be issued at a discount. Sweat equity share can be issued at a discount. Similarly, ESOP cannot be issued consideration other than cash. You can see ESOP can be at a price which is below the market price, but it cannot be at a discount. It can be below the market price, but it cannot be below the face value. Whereas sweat equity share can be even below the face value. These are the three, shall we say, important differences between the two, but more about ESOPs when we come to rights issue. So the sweat equity shares issued to directors shall be locked in for a period of 3 years. That means from the date of allotment, for 3 years, these shares cannot be sold in the market or to anybody. It is called lock-in period. The lock-in period is 3 years. The sweat equity shares shall be valued at a price determined by a registered valuer at the fair price, giving justification for such valuation. This registered valuer is a new concept where they have created a new profession of valuers who are registered. They will give certificate valuation report. Okay. So they will belong to what is known as RVO, Registered Valuer Organization. That is within the framework of the MCA only. So that will be in the final syllabus, you will study it, not now. So the registered valuer have to give a valuation. Based on that only you can allot certifications. Again and again, don't go with the 52 rule. See, 52 main section is the 5 matters. No restriction on them. They have again repeated it in the rules. That's all. No restriction. It is not as if the only these 3 matters are allowed, though above the other 2 are not there. No. Act will always prevail. All 5 are available. In addition, they are given 3, but it is not in addition. What to do? Sir, with folded arms, I beg you, don't ask me to explain what the Ministry of Corporate Affairs is doing. Okay? And don't try to do it also. That way lies madness. Let me assure you, 52 prevails. 5 matters are there. These 5 matters, you can use the security premium account. Chalo? Don't go. The purpose of lock-in is to prevent the employee. See, idea is that he shouldn't sell it and go away. That's all. Nothing else. To create some sort of a loyalty. He can't run away. Actually, there's no need because no need. But see, after all, this director is coming. I'm giving him shares. Tomorrow he should not sell and go. So they say minimum 3 years. Okay, the purpose. See, promoters' contribution in a public issue, there is a lock-in period of 3 years. There, the idea is the promoters or the directors of the company management should not go public, allot shares to the public, and quietly sell their own shares in the station. Where I will prepare 5 employees to sit in the audience. Because nobody will be there except these employees. We will make them sit in the audience for quorum purpose. I need 5 people. I make them sit and we'll conduct the AGM. Okay. They won't ask any questions and all that. In fact, I myself will feed a couple of questions to them and say, you ask, sir, how can I ask, sir? MD, sir, like that. Yeah, go and ask. Like that, I will ask. Your MD will be laughing. He says, Srikanth, what? No, sir, let it be recorded. Question was asked to you, answered. Let it go in the records. More about it when we come to management and administration. Okay, video got lagged. At least once in a session, if this does not happen, I think it's a problem. Anyway, I'm not able to do anything. In case the tech support gentleman tells me that my video is lagging, we will see something. Otherwise, I can't do it. Suddenly, it will become all right. Don't worry. So anyway, what I told now is what you missed is not very important. Don't worry. Just give me 1 minute. Gautam, classல இருக்கேன். நீங்க வந்துறீங்களா? Yeah. Okay, thank you. Going on. So now we go on to an important topic, issue and redemption of preference shares. This again is a topic I'm sure you would have studied in accounting. Preference shares. We already saw what is a preference share. Preference share is a share carrying preferential rights. Shares carrying preferential rights as to payment of dividend and repayment of capital at the time of winding up. Okay, so they will, before the equity is paid, you have to pay preference. Before the equity is repaid the capital at the time of winding up, you have to pay the preference. So they have a preferential shareholders have a preferential right for repayment. So based on certain criteria, you have different classes of preference shares. I'm sure you know this. I'm sure I'm wasting your time telling all this, but then again, quickly. Cumulative, non-cumulative. See, question is simple. Every year, preference shareholder is entitled to compulsorily dividend, fixed dividend, and that too before equity. So 12% preference shares means every year he is entitled to 12% dividend, right? Now, that 12%, suppose in 1 year I have a loss. How do I pay? I can't, because dividend on preference shares is not a charge against profit. It is an appropriation of profit. So if after reducing all the expenses, you do not have money, you cannot pay preference dividend. It's not like a debenture interest where I can pass an entry on accrual basis and show it as a loss, claim it as an expense. It is not a charge against my profit. It is an appropriation of my profit. So where there is no profit, how will I? So in the year of loss, I cannot pay preference share, right? So that year gone. But suppose it is a cumulative preference share, what will happen? The dividend will be accumulated. So in a year of loss, I will calculate the dividend and provide and keep it. But later, when I make profit, I have to give. In fact, I won't provide also. Actually, I don't think I need to provide, because by providing, I get no benefit. But I can create the liability and keep it, right? I can create the liability and keep it as a matter of record, because for income tax and all, this is not available as a preference dividend is not a deduction. You cannot claim preference dividend as a deduction from business income. Okay? Interest can be claimed, but not dividend. Preference dividend you cannot. But I will accumulate it, and in a future year, when I have money, all the accumulated arrears of dividend will be paid. That is called cumulative preferential accumulation. The dividend is accumulated and paid every year. But if it is non-cumulative, then in an year of loss, he won't get dividend. Next year, if there's a profit, that year he will get. The old won't be accumulated. That is cumulative. Participation in profits. See, after the equity, people have been paid dividend. Preference shareholders have been paid dividend. Then equity also paid dividend. Then there is some profit left. In that balance profit, if the preference shareholder again gets another 5% dividend, that is called participatory, because he is entitled to participate in the profit remaining after equity have been paid. That's called participatory. If that is not there, it is called non-participatory. Convertible, we already saw. The preference share, instead of being redeemed, will be converted into equity upon terms, upon valuation. That will all be decided in the terms of issue, right? So at the time of issue, I should tell him, you can convert your preference share at 300 rupees, like that, whatever, right? So, because I can give him at par, na? But at that time, I don't know what the valuation will be. So I try to work out a valuation and I tell him, 5 years later, every preference share, or rather for every 3 preference shares, I'll give you 1 equity share, like that, something like that, okay? So that is called convertible. And we already saw that, partly convertible, fully convertible, non-convertible. Non-convertible is that it will be redeemed. It will not be converted. Redeemable means, redemption means repaying the money. So redeemable preference shares, of course, I have used the word non-redeemable here. Irredeemable is also correct. Maybe irredeemable would be a better word. I can correct this if you want, but why should I not correct it? Okay, I will correct it. Because actually irredeemable is the word. IRR, irredeemable. So, okay, redeemable means it will be redeemed or the amount will be repaid after a certain period. Irredeemable means it will never be repaid. Okay, in India, you cannot issue irredeemable preference shares. No company shall issue irredeemable preference shares. You have to issue only redeemable. But the redemption period may be not exceeding 20 years, right? Terms and conditions are there in Rule 9, not relevant. It is enough if you know that maximum period for redemption is 20 years. You can issue preference shares redeemable within a period not exceeding 20 years. And even this requires an authorization in articles. Issue of preference shares for a period exceeding 20 years, but not exceeding 30 years is permitted for infrastructural projects. Schedule 6 to the Companies Act has a list of infrastructural projects, not relevant for your exam. Just to know that it is in Schedule 6. If it is an infrastructural projects could be road, laying of roads, construction of dam, airport. These are all infrastructural projects. Obviously, the gestation period for them is long. The return will come in a long period. So in those cases, they can say even up to 30 years, you can take the money and keep it. You can redeem it after 20 years, but not exceeding 30 years. Because infrastructure projects, take a long time to complete and then operate. For example, I may construct a road, highway, and then I will be going what is known as build, operate, transfer, BOT. Build, operate, transfer. Means I will build it, then I will operate it, collect the tolls, make money, and I will then at the end of the, say, 40 years or whatever, I will transfer it to the government. Build, operate, transfer, BOT scheme they call. So it will be long gestation periods. So they say you can take it for more than 20 years, also up to 30 years. But if it is going to be more than 20 years, then from the 21st year onwards, 10% of the preference shares are to be redeemed annually on proportionate basis at the option of the preference shareholders. So redemption will happen in installments so that you don't have to repay in one shot at the end, right? Very interesting and very important thing. Nalini always wants a break. I'm so sorry, but don't expect a break today. But I will be closing it early. 9:10, I will close it. Okay. So it's hardly 8:31. Another 40 minutes you hold on. Okay. Don't worry. Okay. Unless if you want, I'll give a 5-minute break. 5-minute break. 5 minutes, sir. 5-minute break, sir. Break, sir. 5 minutes break. I will start. from your, I hope, refreshing break. Sorry, it's not very long because I need to close a little early. I'm now in a place in Tamil Nadu called Coimbatore. I'm not in I have a residence here in Coimbatore and again in Chennai. So I'm moving from Coimbatore to Chennai today. My flight is at 11:30. So I need to go. That's why I'm closing it a little early today, like say 9:10. That's why I didn't want to have a break. It's okay. Chalo, no problem. Let's hope to complete this topic. Please give us breaks, sir. Nalini, madam, I have given you break. Yes, Muktaji, the lock-in period means if employees don't accept them, we cannot offer it to the general public before. No. That is different. See, when you come to right shares, I will tell you. Don't confuse. In rights, there is something called, in case these people say, I don't want, then we can offer it to general public. That is not lock-in. Lock-in means I allot the share to this donkey. He cannot sell it for 3 years in the market or to anybody. That is called lock-in. That share cannot be transferred for 3 years by the allottee. Okay, he is accepting the share. After accepting, there is a lock-in. We are saying you can't sell it for 3 years. For promoters' contribution, it is there. See, for sweat equity and I seriously don't see the need, but it is there. Idea is, see, suppose he is a director, he becomes a director here. The terms and conditions, even then, sir, there is no justification for lock-in for sweat equity. In case you are able to think of something, share, I will learn. Okay. Return at the time winding up, please give us break. Sir, now irredeemable preference shares are not allowed to be issued. Correct. You cannot issue irredeemable preference shares. Okay, maybe before I told that you have told. Okay. No problem. No issues. Okay. If it is irredeemable preference share, it can be repaid only at the time of winding up. Yes, at the time of winding up, you have to repay, Baba. Irredeemable doesn't mean never. Irredeemable means during the lifetime, no. And you cannot. In India, there is a prohibition on issue of irredeemable preference shares. Please remember that. So that category, earlier it was there. Okay. Earlier it was there. Okay. Earlier it was irredeemable preference shares were there. But now, in the new law, it is not there. That's all. Conceptually, see, there are many things where the concept is there, but it may not be there. You're able to understand. See, concept is there. Then that concept we are given a name, but in reality, it may not be there. Am I correct? So, conceptually, it may be there. Why irredeemable preference shares are now prohibited? See, people, maybe government feels some redemption, some because what happens now, if I take irredeemable preference shares, the promoters, the management, they take irredeemable preference shares, there will be no responsibility, right? Think about it. Suppose somebody is giving me 25 crores and I need not redeem it at all, and only at the time of winding up, and I will come anytime. Will I be very responsible in my management? I will be casual now. So when there is a pressure on redemption, say 10 years later or 5 years later, you have to generate a profit, Bob. You have to be able to repay it. Am I correct? So you have to, you will invest it in the assets. It will be used as a source of investment. Use the asset, earn money, put aside a reserve. Then at the end of 5th year or 10th year, redeem. So when that pressure is there, the way they will operate will be different, right? That is why they say no irredeemable preference shares, right? Very practical question. Can I alter the period of redemption? My answer is SEBI guidelines, no. Listed company. But unlisted company, what you can do, you can call a meeting of the preference shareholders. And at that meeting, if the preference shareholders pass a resolution, it can be done. You can change the terms of issue, post-issue, but you can't do it unilaterally. The board of directors cannot do it. You have to call a meeting of the preference shareholders, and at the preference shareholders meeting, they have to pass a resolution. Okay, and ordinary resolution. Then you can. That is my best answer I can give, because there is no section there for this. But it's a good question. Variation of terms post-issue. Okay, and preference shareholders have voting right. Himanshu yes, in the last class we discussed it. Do you remember? On matters which directly affect them, on winding up, where their interest is affected, These are the three subjects where preference shareholders are entitled to vote. For example, post allotment of the share, I want to change the terms of issue. Redemption, I want to make it 7 years instead of 5 years. This will directly affect the preference shareholder, right? On those matters, he has the right to vote. And you have to call a meeting, and at that meeting, the preference shareholder has the right to vote. Got it? Finally, in case preference dividend is not paid for 2 years, whether cumulative or non-cumulative, 2 years you have not paid him, then he will be entitled to vote on all resolutions. Irrespective if he is interested or not, it will affect him or not, he can vote. Okay. We discussed this yesterday, Himanshu ji. What do you say? Anyway, no problem. Neha Verma says, understood. What did she understand? Thank you for reading. Watching. See, my guru taught me law. Professor K. Santraman taught me law from a practical perspective. So, not from a theoretical perspective. So, I always like to think practically. What is the point in this? Why is it like that? Why? Okay, so that the minute you keep mugging up without understanding, it becomes meaningless. Dukuran Karane is Hari Shankara says, Nahi Rakshati, Dukuran Karane. Merely mugging up and, not going to help you. You should think. So these questions are very good. I love you all as students because you're asking really beautiful questions. Sometimes I tell the participants of my workshops, it is not about having all the answers. You are not great because you have all the answers. You are great because you asked the right question. See, you asked the right question. When the apple fell on the ground, you and I would have eaten it. But the great man called Isaac Newton, he asked the question, why is it falling? Why is it not going up into the orbit? Why is it falling? See, that was the right question. And the whole physics came after that. Okay. So it's not about having all the answers. I'm not really interested in having all the answers. I can always look up the answer, but I want to be able to continuously ask the right questions. And that way I'm very happy that, I have extraordinarily brilliant students like you, Prabhas, Mantanjali. I mean, if we keep on telling names, some of you left out, don't get angry. One student got angry for that also. She put, please don't mention names, sir. That means people whose name you are not mentioning will be hurt. Are to be redeemed out of the profits of the company, which would otherwise be available for dividend. Now you understand, once there is redemption pressure, I have to generate profit because only out of profit I can redeem the preference share. So preference shares are to be redeemed out of the profits of the company, which would otherwise be available for dividend. Which means, can I use securities premium account for redemption of preference shares? No. Why? Because security premium account is not available for dividend. Revaluation reserve not available for dividend. Like that. So in the exam, they might give you a list of reserves. Be careful and select. Proceeds of a fresh issue of shares. Okay. I have to redeem the preference shares within 5 years. It so happens the company did not make enough profit. Right. How do I redeem now? They say, okay, you want to redeem these people? Then you have to make a fresh issue of shares. Out of that fresh issue, you repay this. What do you say? So the proceeds of a fresh issue of shares, okay, can be used for this. So when preference shares are redeemed, there will be a diminution in the permanent capital of the company. That permanent capital should be replaced. Got it? When I redeem preference shares, straight away my permanent capital in the balance sheet is going to go out. Now, so the law says, if that goes out, something else should replace. So one way is free reserves, general reserve, all that. You take it and put it up and lock it. In other words, you convert it or you transfer it to something called capital redemption reserve. Once I put it in CRR, I cannot use it for declaring dividend. So the free reserve will get locked up. It is no longer free. Capital redemption reserve cannot be used for declaring dividend. And again, note, you have to transfer the face value of the shares. Okay, not the premium and all. Face value. Suppose I'm redeeming preference shares at a premium, only the face value of 10 rupees or 100 rupees I have to transfer to CRR to the extent that I am redeeming it out of profits. And that CRR can be used only for issuing bonus shares. Okay? Or you can issue fresh issue. In which case, you can use only the face value for redeeming. Why? Suppose you are collecting a premium at the time of issue of the fresh shares. That premium is a security premium. It can be used only for those 5 purposes. You cannot use it for redeeming preference shares. Therefore, let us say that I am issuing equity shares 10 rupees at a premium of 20 rupees. That extra 20 rupees that I am getting, I cannot use it for redeeming preference share. Only 10 rupee face value can be used. Right? You can use both options also. You can either partly out of profits and partly out of fresh issue. Idea is, at the end of this exercise, the balance sheet will not be, there will be no diminution. The general reserve will be transferred to CRR, locked. No dividend can be declared out of that. Or fresh issue ka face value will be there. So there will be no diminution or reduction in the permanent capital. This is a bit of a conceptual matter. I hope you understood what I said. You are asking a question, Poojaji, from ESOP or sweat equity. If an employee resigns within the blocked, don't say blocked period, lock-in period. Yeah. See, you cannot restrict employment. You cannot say, if I allot share, you should never resign and all. That is amounts to slavery. See, he is getting this because already he has gained something for me. There is a consideration already provided. He has given value addition, whatever. For that, I am giving him shares. That over. Thereafter, next day, he can resign and go. Lock-in is for the share, not for the employee. Okay, he can go. You are living in a free democratic country. Don't forget that. Always celebrate democracy. You are at liberty to do whatever you want, including killing yourself. Okay, so drinking and going to spoiling your health. Everything you are free. You are at liberty to do. Of course, you are also at liberty to become a chartered accountant. You are at liberty to make a success of your life. You are a free person. That's all. That one thought should give you joy, that we are free to do whatever we want, to plan our life and live the way we want to live. Okay, that is the meaning of democracy. Good. Sometimes I will talk like this. Don't get angry with me. I'm motivating myself more than anybody else. Because before I motivate other people, first I have to motivate myself, right? Sometimes, I see people, especially CA students, like that they'll be keeping the face always serious. Sorry, that is not my way. My way is fun way. Even when I was a student, when I'm still in practice, fun. Even in my office and all, I just have fun. I say, come on, enough. You're doing a great job. Always serious, sir. According to section 53, according to section 40. What is that? Right. So, issue and redemption of preference shares, section 55. We already saw this. Preference shares, yeah. Now, Himanshu Gupta told at that time, sir, preference shares to be redeemed have to be fully paid. Absolutely correct. Preference shares have to be fully paid. Then only you can redeem them. So if it's partly paid, you have to first make it fully paid up. Call up. And then only you can redeem it. Authorization by special resolution. Got it. The nominal value of preference shares redeemed to be transferred to CRR. To the extent that it is redeemed out of profit, I have not mentioned, but please add it. To the extent you are redeeming it out of profit, the nominal value of preference shares redeemed to be transferred to capital redemption reserve. CRR not to be used for payment of dividend, but can be used for bonus shares. So here's a small question. Of course, you have done it. Then I will skip it. When you get the thing, you can do this. The idea is I'm just reinforcing the point here that see, when we are transferring out of profit, right? See, S Limited issued 2010% preference shares of ₹100 each at par, redeemable at a premium of 10%. For the purpose of redemption, the company issued 1,500 equity shares of 100 each at a premium of 20%. At the time of redemption, the amount to be transferred by the company to the CRR. So, first I have to take what is the issue. Issue is 1,500 equity shares, 100. 1,500 into 100, 1,50,000. Preference shares to be redeemed, 2,000 into 100, 2 lakhs. So, only the face value you have to take. The premium on redemption, don't bother. The premium on issue of new shares, don't take. What you should take is 2 lakh is to be redeemed, 1,50,000 I'm going to raise face value of equity. The balance shortfall is 50,000. That only will be coming out of profit. To the extent that that is coming out of profit, it has to be transferred to the CRR. Okay, so fairly simple for a CA. This is not a CA level question. This is not a CA level question. This is a below CA level question, maybe foundation or CPT level question. or ACS question, not meant for CA students. CA student, tougher question will be there in accountancy. The idea why I am using it here is to theoretically make you understand that the nominal value of the preference shares redeemed only should be considered. That is 2,000 into 100, 2 lakhs. The premium that you are paying on redemption should not be considered. That premium will have to be adjusted out of the premium that you collect from the equity. Otherwise, it will be lying in the balance sheet as a negative under reserves and surplus. That's all. Till you write it off over a period of time or whatever. So the answer is pretty like that. Same thing when you're going for a profit also. The balance in the P&L account you can use for redeeming preference shares. So you are redeeming 10,000 preference shares of rupees 10 each, 1 lakh. Balance in P&L is 60,000. That you will utilize it. The shortfall is 40,000. You can issue shares, even if you issue it at a premium, for the purpose of the issue, the face value only should be considered. So 10 rupees into 4,000, 40,000. That 40,000 rupees or 4,000 equity shares. The shortfall is 1 lakh minus 60, 40. Divide by 10, you get 4,000. So you'll have to issue 4,000 equity shares. The premium that you're collecting on the fresh issue can be utilized for writing off the premium on redemption if you want. Okay, if so. But it cannot be used for redeeming. All right. Now, suppose a company is not able to redeem the preference shares. If a company is not able to redeem preference shares, then unable to redeem preference shares or pay dividend on the preference shares, then what to do? It has to obtain consent of 3/4 in value of the preference shareholders, not special resolution. Don't confuse. This is the section prescribes 3/4 in value. Okay, which means I should call a meeting of the preference shareholders, or I should write a letter to all the preference shareholders, and out of that 3/4 in value means, let us say that the preference shares are 20 crore worth of preference shares are held by 4 people. 20 crore worth of preference shares are held by 4 people, right? One guy is holding 17 crores. The remaining 3 together are holding 3 crore, 1 crore each. One man is holding 17 crore. Now, I have to obtain the consent of 3/4 in value. So, though these guys are 3 majority in number, not enough. That guy who is holding 17 crore, 3/4 in value, should agree. More than 3/4 in value. Unless he agrees, this won't go through. So, you have to obtain the consent of 3/4 in value of the preference shares. Then, after obtaining the consent, you have to go to the tribunal. Because you can't decide it on your own. The tribunal will go through it and see everything is above board. Then they will give approval. Then what happens is, instead of paying back, you will issue further redeemable preference shares. Right? Further redeemable preference shares. Which means this redeemable preference share will be repaid by another set. Maybe giving 5 years time. Okay? Now the unredeemed preference shares, once you do this, shall have to be deemed to have been redeemed. Deemed. You have not redeemed, but by issuing the fresh preference share, the original unredeemed has been redeemed. Deemed. Okay. In my example, 4 fellows were there. One fellow held 17 crore. Then there were 3 guys each holding 111. Now, suppose one of those guys is not happy. He was not voting for. He voted against. But because 3/4 in value agreed, he has to. How about the preference shareholders who have not consented? So he will make an application to the tribunal and say, I am not happy. Then tribunal, while giving the approval, will order the redemption forthwith of the preference shares held by them. So the dissenting preference shareholder, forthwith they have to pay. Okay. That is, who will decide? Not the company, not the preference shareholder. Tribunal, judicial, quasi-judicial body will decide. Suppose 3/4 have agreed. The remaining 1/4 fellows are unnecessarily creating problem with the intention to irritate. Then the tribunal will say, no need. Everybody's agreed, you also come. But suppose genuinely the fellow comes and begs. He says, sir, I need the money, my daughter's marriage, 1 crore, please give back. Then the tribunal will say, pay. Once the tribunal directs, forthwith means almost immediately, without delay. Forthwith means without any delay. Pay. You have to pay it. Okay. We move on to another interesting topic called transfer and transmission of shares. Okay. Okay, let's see if any questions are there before we move. 50,000 is CRR okay too. Okay, you are answering the question. Beautiful. So fantastic. Thank you, Ms. Nalini, for that. Now moving on. Transfer and transmission. Transfer means change in the ownership of shares. Any transfer is change in the ownership. Under the Income Tax Act, you have transfer. Definition of transfer is there. 2 subsection 47. What is transfer? Then 47. What is not transfer? Etc. etc. Transfer means change. So in the context of the Companies Act, transfer means change in the ownership of shares through sale, exchange, acquisition, everything. Even a gift is a transfer. Gift is in vivos. When both the parties are alive and the gift is given, it's a transfer. Except that there is no consideration for natural love and affection. But it's a transfer. So any change in the ownership of shares through sale, exchange, acquisition means buying in the open market or from another person, or gift, etc. Transfer is by act of parties. Transfer is evidenced by an instrument of transfer. We will be seeing that. I already told you why there is an instrument of transfer. Because shares are movable goods, movable property. They are goods. And as such, transfer of shares, okay, the ownership of in shares is transferred by mere transfer of possession. But instrument of transfer is there to inform the company about the completion or the closing of one contract and opening of another contract. Because the memorandum and articles are a contract between all the members and the company, and the members inter se. Therefore, when one member sells, he is walking out of the contract. He has to inform transferor. The other member, other guy who's buying is now going to enter into the contract. He has to inform in writing. Then when the company makes the change in the register of members, this man will become a member. Till such time, he is only a shareholder. Are you able to understand the difference? He purchased the shares, paid good money, he is a shareholder. But unless his name is entered in the register of members by the company, he is not a member. Okay, the slight difference between shareholder and member. Though these two terms are used synonymously, member means person who applies in writing to become a member and whose name is entered in the register of members or updated in the records of a depository. If this is satisfied, then he is a member. Otherwise, he is not a member, he is only a shareholder. Be careful. In the Act, many times they use the word member, certain rights. At that time, check out. Mere shareholder cannot. Your name should be in the register of members. Only then you are a member. Transmission means change in ownership of shares due to death, insanity, insolvency, etc. What happens? Somebody dies. At the time he is having shares. Who will get the share? His legal heirs. Okay, his legal heirs. Right? There's a separate Indian Succession Act is there. Under the Succession Act, there is a list of legal heirs. First level, second level. For example, mother and father are first level. Wife is first level. Children, first level. Yes. Then you have second level, third level. Okay. Wife is part of this. Wife. So it's not as if from father to, suppose a man dies, he's got wife and 2 daughters and 1 son. There are 4 legal heirs. Wife, 2 daughters and 1 son. All are legal heirs. Even married daughter is a legal heir. Okay. So it's your daughter now. So she is also entitled. She is a legal heir. Okay. This is the point. Anyway, legal heirship certificates are there. All that sort of legal formalities are there before you can claim. That is why I always advise my clients, and for me also, my own father did it. When alive, settle. When alive, gift. By the time you are 75, you decide to go for Vanaprastha, then why are you holding property? First you let that go. Then only you can leave and you can have moksha. Man who is after money cannot go to moksha. He cannot get moksha. Jesus Christ also said that, no? It is easier for a camel to pass through the eye of a needle. It is easier for a camel to pass through the eye of a needle than for a rich man to enter the gates of heaven. So better to let go. Then you are free. Without burden, you can go for next level. Sorry, again, Saturday morning philosophy not needed. Sorry, useless. Sorry. Okay. Transmission is by operation of law. Means death. Same way, suppose somebody becomes insane, then he will be a ward of the court, who will then some relative will take control of the affair. So by operation of law. When a person becomes insolvent, all his assets will rest with the official receiver or assignee. The court will take over and they will appoint a receiver or assignee or a resolution professional. Of course, in the case of a company, this won't happen. Why? Because there's no debt for a company, A. B, till the moment of winding up, the company is capable of holding shares in its own name. Got it? Till it is capable of holding. Except that once winding up commences, the directors will no longer have any authority. The liquidator will get authority. That's all. But individual, if he becomes insolvent, then his assets will rest with the court, official receiver or assignee attached to the court. And that man will sell the share and pay the creditors. So in those cases, there is a transmission of ownership by operation of law. So transmission should be evidenced by a legal heirship certificate. I told you, succession certificate, because if there's a will, then there is no way, according to me. I tell people, don't write a will, Baba, because only a cost. Because once you have a will, the will has to be probated in the court. And you have to obtain a succession certificate from the court. Only then you can dispose the asset as per the will. Okay. And the will has to be probated. The idea is simple. Suppose the properties are huge, there could be a contest. So the probating activities when the High Court or the appropriate court will issue a public notice. Anybody having objection can come. So no objection is received, then they will pass an order, go ahead and give effect to the will. Then the executor of the will can go ahead. So that succession certificate you should enclose to the company. Or in case of insolvency, insanity, etc., order of the court. So if you are the person taking over the affairs of an insane person, then you should get the order of the court. That the court will clearly pass an order on the matter. It say, we have examined, medical evidence has been examined, and we hereby declare that so and so is he is not capable mentally. Okay, he is not capable of taking his own decision. We hereby authorize so and so to become the guardian. That's all. That document has to be sent to the company. Then the company will change the name. And so this is transmission. But for many things, transfer and transmission are the same. Because as far as the company is concerned, new ownership, old owner no more, new owner coming. I have to make a note. So for me, it is all the same. Manner is different, that's all. But for me, I'm only going to change my register of members and put a new entry, that's all. So the transfer of shares should be in form Ch-4. Ch-4. It should be duly stamped, dated, and executed by or on behalf of transferor and transferee. Why? Because if you are informing the company, one contract getting over, another contract starting. Name, address, and occupation, all that is there in Ch-4. It should be delivered to the company within 60 days. Very, very important. Within 60 days from the date of execution. Along with it, if it is a physical share certificate, you have to enclose the physical certificate. See, for dematerialized share, it's so easy. All this blah, blah, blah is not there. Straight away, the DP will inform the company. Once the share is sold, the DP, the receiving DP will inform through NSDL and CDSL. That information will directly go to the company and company will make all this is not there. Physical certificates, you have to enclose it along with the application transfer form SH4. See, this form SH4 is used only for off market. When you're doing it in market, virtual trading, buying and selling on the market, no need for SH4. Because then how many SH4 you'll be filling up? Every day, you'll be buying and selling. All that is through depository, no problem. Only other than depository, you have to do all this. So if there is no share certificate, should be enclosed. If such share certificate itself is not there, some problem, then at least the letter of allotment should be given. Okay. Or you have to apply and get a duplicate share certificate. That itself is very difficult. Okay. So here is a question. As I told you, I'm going to stop around 9:10. So yeah, instead of saying inevitable circumstances and all, why don't you use the word operation of law? That's all. Yeah, it doesn't happen due to inevitable circumstances. It's operation of law. something happens. As you said, death is an inevitable circumstance. But basically, the transmission is due to the operation of law. Dematerialized form, no seal, bill and all, nothing. Dematerialized, yeah, it's fungible, it's a record, it's a digital record, no seal. Physical certificates need the seal of the corporate seal of the company. See, today, last time I saw a physical certificate was about 15 years ago. Yet to see. Okay. Anyway, so Radha is the original allotee of 2000 equity shares in Murthy Mechanical Toys. She transferred it to Ruchi. The instrument of transfer is dated 21st August 2020. Duly stamped and signed by Radha, was handed over to Ruchi. See, stamp is stamp duty. Every state has a stamp duty. I think it's a central subject. Yeah. So the stamp duty on share transfer is central subject. Some percentage, I forget, 1% or something. Totally forgotten. It has to be affixed on the share transfer form. Or you have to give the proof of having paid the stamp duty. While uploading the Ch-4, you have to give proof. And so stamped and signed. So just like for transfer of property, you have stamp paper. Similarly, when your physical shares are being transferred through Ch-4, you have to pay stamps. You have to buy the share transfer stamp and affix them. It's a central subject. The stamp duty is decided by the central government. And they have fixed it. I think 1%, I forget. Sorry, I don't know. If you want, I can verify and tell you. Otherwise, you can look it up. Not relevant from exam point of view. Nobody's going to ask you. For company secretary, yes. Not for you and me, no need. So it was duly stamped and signed by Radha and was handed over to Ruchi. Now, advise Ruchi regarding the latest date by which the instrument of transfer along with the share certificates must be delivered to the company to register the transfer. Okay, so when was the instrument executed? 21st August. So 60 days. Do you remember? It has to be sent within 60 days. Now, please, point to be noted, do not include date of execution while counting the number of days. This is from the General Clauses Act. Please, if you read, when you're taught General Clauses Act, they will teach you. Whenever you're counting days, count from the next day. You will exclude the date of the event. So here, so 21st means you count from 22. You make your own calculation, 22. So if you're taking from 22 August, in August 10 days, then September 30, okay, so 10 plus 20, 10 plus 30, 40, another 20 days in October. So 20th of October will be the last day, before which you have to submit the, Ruchi has to send the, otherwise the share transfer cannot be just beyond the due date. Got it? Point is, do not include date of execution while counting the number of days. That is all I'm trying to use this example. If I explain it without this example, no, you'll get confused. So I'm giving an example. 60 days. The thing should be sent within 60 days. Right? Suppose you have lost the instrument of transfer or there's a delay in submission of IoT, the board at its discretion and taking an indemnity bond may register the transfer. Okay. The above provisions do not apply to bonds issued by government companies, not shares, bonds, debt instruments issued by government company, not applicable. Provisions do not apply to shares held by nominees in a government company. For example, a government company may have central government as a shareholder, right? Now, who will be the owner? The President of India. He will nominate a person to represent him on the companies as a member. Later on, when we come to management administration, we'll see. If so, that nominee's name, when it is changed, now that won't amount to transfer of shares. You will not bother. Partly paid shares. You have to be careful. Partly paid shares means what? There's a liability on the shares. So, if the transferee is making the application, no problem. He's saying, no, he's going to pay the liability. He's saying, but if the application for transfer of partly paid shares is being made by the transferor alone, means the transferor is saying, I'm transferring these shares to him. He signed here. Please transfer along with the liability. Now, the law says a notice is to be given to the transferee in form SH5. And the no objection certificate is to be received from transferee within 2 weeks. So if NOC is not received, then the transfer shall not be registered. Even though the man signed and all, still we'll say we have received a form. Are you interested in accepting the partly paid shares? If he says, hey, we have no objection, then and only then can you register. Otherwise, if the transferor sends the shares for transfer, partly paid, this is the procedure. But if the transferee himself is sending it, no problem. Certainly, he himself is sending. I can't send a notice back to him here. See, somebody was asking a question in an earlier class regarding IFSC and all. Anyway, chalo, we will not take it up now. We will take it up in the next class. In the next class, we'll take up further topic of transfer and transmission. We'll also talk about what will be the remedy for refusal or delay in register of transfer. Okay. Thank you very much for your kind words. And we can sell shares in Demat account. Can we transfer shares to particular? Yeah, you can. That's called off market. There's a depository, DP advice will be there. DP transfer advice. You have to sign it and give it to him. Then he will take it and do it. You can transfer to particular person through Demat. Yes, why not? You can, you should. Sometimes I do that. Somebody off market, we call it. You don't have to go through the virtual trading. Off market to do, but then you have to give a DP advice. Then the DP will then transfer it to you. Your DP will transfer. The guy who buys it from you, he will send it to his DP, and through DP it will get transferred. They will take it. Again, it will be done electronically only, right? But there will be a document, because otherwise, how to give the instruction? Right? Beautiful. Thanks for the beautiful questions. Keep the questions coming. Next class also, and looking forward to seeing you again, inshallah, on Tuesday. Bye.